Hi everyone, welcome to bonus module number 1, in which we're going to go over in detail a system for triggering yourself into trades, which I call the MACD parabolic entry system. We alluded to this in module 8 of the course. In the top-down trading examples, we showed a couple of examples where you can use the components to trigger yourself into a trade, but now what we're going to do is really flesh that out and attain a deeper level of understanding how to use it. I can't stop talking about this system. It's just done amazing things for my trading results, personally speaking. I was often, not until not too long ago, routinely looking at reward to risk ratios on my trades of, sometimes even less than 1-to-1 or just about 1-to-1 or a little bit more. Sometimes if I was lucky, maybe 1.5, 2. And it's because I was all over the place with my entries and my stops. And by sort of converting myself to the system, I'm routinely now hitting reward to risk ratios on my trades well in excess of 3-to-1. And sometimes as high as 5, 7. I've had a few trades 10-to-1. And we're not talking about position trades here. We're talking about intraday trades, some that I hold for a couple of days. But it's a really great thing. That's all I can say. And I hope you will catch some enthusiasm for this and realize what it can help you do with your trading. So what the heck are we talking about with MACD parabolic entry system? Sounds fancy. It's really not fancy when you've learned it. It's fairly simple to apply. Actually, that's the beauty of it. It becomes very, very simple. We're using applied pattern recognition, and we're looking essentially for two paradigms or two schematics. I'm going to show you an overbought and an oversold schematic each that pertains to the system. And once you've learned what it looks like, it becomes very easy to find one and to find a good entry point for you in your trades. So we're looking for the exact same sequence over and over. It doesn't change from one trade to the next. It's like we're looking for an apple in a fruit bowl, and once we've learned what the apple looks like, it's pretty obvious. So we're going to try to remove the guesswork about when to get ourselves into a trade and where to place our initial protective stop. And it's because this system more or less does the thinking for us. It's mechanized. Let's face it, if you don't have a mechanical system for triggering yourself in, let's say you're trying to work with a trend line break, and you see price breaks the trend line and then sort of goes sideways or drifts away on you, and you're wondering, well, okay, when's it time for me to actually get in on this setup? And this system really does that work for you. It will tell you when it's a good time to get in because the trigger stands out like a sore thumb on your chart. And as far as where to place the stop, well, let's face it, often this can be an issue of guesswork. Let's say you're taking a short and you're looking at your daily pivot, say, you might think to yourself, oh, okay, I don't know, maybe I should put my stop 10 pips or on the other side of this pivot, or maybe 20 pips. Who knows? It's always guesswork when you do it that way. And let's face it, that doesn't lead to consistency. That leads to sort of making it up on the fly. Sometimes you might be right, sometimes you might be wrong. But having a mechanized system to tell you where to get in and where to place your stop, it gives you that much more confidence. It makes it a lot easier to execute a trade. Now, of course, this is not to suggest that you can just forget about doing your proper homework, which is to review all of your charts top down to find out what's going on. You might have, you might be having a consolidation range on a daily chart, and then say a trend line break set up on a 4-hour or 2-hour chart. You really have to know all of those things heading in. And this entry system that we're talking about is really just the very tail end of your analysis when you've decided which way you want to go based on higher level setups. So it doesn't take the place of doing proper homework, and it's never to be traded on its own merits. In fact, we always have to validate the signals we see on higher time frames. So the first objective really of the MACD parabolic entry system is to try and time our entry points fairly precisely. We don't take the advice to heart when it's said that trying to pick tops or bottoms is foolhardy. Don't buy that at all. I've been absolutely stunned. I'm not kidding you. When I look at some of the trades after the fact, say go back to an hourly chart and consider where relative to the hourly chart I got in on a trade that unfolded the way I expected. And it's just amazing to see how close to a top or a bottom you can get with this thing. It's just really useful for that. We're also trying to limit our risk even further by having the system generates very nice tight stops for us. If you're trading even a fairly frisky pair like pound yen, which I do, you can routinely keep your stop risk down to the 20 to 25 pip level, which for pound yen is amazing because, as you might know if you've ever tried to trade it, 25 pips is nothing for that pair. It's literally a heartbeat, at least in a fairly active market. But if you don't trade one like that, if you trade something that moves a little slower like Euro USD, for example, or USD CAD or one of those pairs, which is more likely to put in, say, no more than about 60 to 80 pips on an average day, the stop margin becomes potentially even lower than that. I've looked at trades on Euro and USD CAD that were in the 12 to 15 pip range, which held up just fine through the trade and was not knocked out by any kind of retracements or pullbacks or anything like that. You have to be careful, and we're going to talk about having a threshold minimum stop level, but to be able to get our stops routinely into around about the 15 to 30 pip range, I mean, who can't afford that for virtually any type of trade, especially where the profit objective is anywhere from, say, 50 pips on up. It's not a lot of risk to incur for virtually any type of trade. And if you're a position trader, you could potentially still use this system. And if you're shooting for 500 pips, well, think about what a limited risk 15 to 30 pips is on the trade. So that's pretty much it in a nutshell in terms of the philosophy of this system. Let's look now at what kind of trading style this might be best suited to. Is it right for you? I really like that car, actually. I wouldn't mind driving it myself. That's a 1960s Morris Minor. Is it right for you? Maybe not. MACD parabolic entry system is best suited to, I would say, active day traders, pivot traders, scalpers. Generally, people who don't mind can afford to spend several hours at a time in whatever trading session they're working, looking for and waiting patiently for one of these entry signals to set up. They happen usually a few times a day, so you have to wait for them to happen, and you have to have the time available to do that. So if you're the type of position trader whereby no, you're perfectly fine taking wide stops, say 75, 100, 150 pips, and that's not a problem for you because you have a really good position trading system that more than pays for wide stops like that. Then hey, you might not care about trying to limit your risk that much further. And similarly, if you're the type of trader who needs to get in and out fairly quickly every day, maybe spend no more than 30 to 60 minutes looking for trades, this won't work for you because sometimes you have to wait for several hours. Now, one way to overcome the boredom that results from sitting around and waiting is to make active use of chart alarms, which is something that IT Finance is really good at. And the examples I'm going to show you are from IT Finance here. AccuCharts also has an alarm system, but I find the one with IT Finance is just remarkably easy to use, and with the paid subscription version, you have the option to create multi-condition alarms, which is really cool because you can tell the charting service if I get price breaking a trend line and something happening on one indicator and on another indicator, give me an alarm. So that can just more or less trigger you back to monitoring your trade live when you get a number of conditions lining up the same way. So you might want to just think about this. I'm really giving a sales pitch to this entry system, but in actual fact, not everybody trades the same way, so it might or might not be best suited for your type of trading, but you'll want to give some consideration to that. So those are just some few ideas about trading styles. going to give you now a rundown on all of the indicator components. It's going to look like quite a shopping list, but it really isn't. When you see it on a chart, it's fairly simple to set up. Here is the table. Running from the price panel on down, top to bottom, we've got parabolic SAR on price. This looks a little bit more complex than it really needs to be. The settings here are just mapped out for you. These are generic defaults that PSAR are often set to, and so you can just use that. If you start to tinker with it, this is really sensitive to settings, so I wouldn't suggest tinkering with it. The one that is used as a default is that specified by Wells Wilder, the inventor of parabolic, and he's worked extensively with settings and has come up with this configuration. It works quite well. We've got our daily pivots, which probably you're using already anyway. We've got our good old friend slow MACD 40-80-10 setting, which I showed you in one of the earlier modules. A fast MACD setting, I set mine to 8-24-9, which I believe is the Joe DiNapoli setting. You could still use 12-26-9, which is the default as well. Then we have SMI, the Stochastics Momentum Index. I only tweak that a little bit on the signal periods. It usually defaults to a 3 period, but I set it at 5 because it just gives a little bit more of that angle and separation attributes between SMI and its trigger line. And then finally the RSI, which is set at a fairly tight 9 period setting. And I use a 3-minute chart. You can use whatever you want. You can use a 5-minute, you can use a 10-minute. I also use a 1-minute sometimes for drill down capability. And it's also important to remember, if you don't like looking at all of these different indicators, SMI and RSI I regard really as helper tools in this configuration. They're not absolutely necessary. I like them. I like to work with them. They're good to provide additional support to the signals we're looking at. But if you really feel strongly that that's too much stuff on your chart, you could conceivably just skip those and use, or you could just skip the slow MACD and use MACD, SMI, RSI, whichever you want. Use one of those two panels instead of both. It's up to you. But those are, just so you know, in terms of what we're going to be looking at with some examples, those are the settings for our entry trigger system. Okay, let's just talk for a second about where the entry trigger system fits in within the overall process of trading. And it's very important to put it in context. So the first thing we're doing is completing a multi-time frame top-down analysis, and we're looking at what the high-level trend is. For example, on a weekly daily chart, we're determining what the tradable trend is on an intraday basis, and by that I mean even if the trend is up, do we actually have a trend down for the session ahead that we're looking at, which is counter trend? Is it tradable or not, for example? And looking at possible setups such as trendline breaks, reversal patterns, and so forth. And then also identifying key support and resistance or key levels that you want to be mindful of. Assessing action in relation to daily pivots. And it's only after doing that work and establishing a trading bias for the session you're in do you then want to drill down to whichever time frame you're using the system on, a 5-minute, 3-minute, or possibly even 1 minute, to get entry signals into the bias. So we're going to go over the overbought signal confluence that we're going to use when we've determined that our trading bias is down or short or looking for a sell, and we're going to look at an oversold signal confluence when we've determined as a result of our homework that we're really wanting to buy or go long. So that's kind of where this signal fits into the overall scheme of things. Like I said earlier, it's really the tail end of your analytical process, and it's important to keep it in that proper context. All right, so this is our overbought schematic, what it looks like lining up all of these different indicators together. And I apologize for the overabundance of small text, but I thought it was really important to document this for you. And since we don't have any kind of actual printed manual or anything, here's all the information for you. You can return to and reference as you need to. So again, reading top to bottom. Now, these are just excerpts from indicator panels. This isn't an actual live trading environment where I've put all these signals together simultaneously. So they're not lining up quite perfectly linearly, but just to give you an idea what the different indicators look like. So from top to bottom, and this is not read in priority order. As a matter of fact, parabolic often comes last, but we're just going to read it from top to bottom. We've got the parabolic indicator in this overbought paradigm or overbought schematic. It will have been trending up to reach an overbought condition for some amount of time, and as it does so, parabolic is lining up underneath price action, and in the case of IT Finance is painting in green. A lot of them don't have this two-color kind of process. It's just white or gray-colored little blobs, but I find this quite effective to have them colored like this. So parabolic, once it flips from green to red at the appropriate time, and this is very important because you can see this kind of flipping thing happen a number of times en route to a true top. It's very important to time this well, but when it's the right time to get in, parabolic will flip from green to red, and that's as a result of price touching the parabolic dot corresponding to this particular candle. When price actually touches it, penetrates it, that triggers the flip. And we won't go into sort of the mathematical formula for how these parabolic values are calculated because it's actually very complex. But just know that when price touches a parabolic dot strongly enough, that will trigger a reversal, which is the R in parabolic SAR. It stands for parabolic stop and reversal. So we're getting the reversal signal here. And so when parabolic flips to the upside of price and paints in red, we're looking at a potential short signal. But we have to, once again, do our homework, time everything correctly. MACD, the slow setting MACD is going to be the toughest thing to work with in this paradigm because it will tend to be later, come in later than everybody else. You won't get a crossover on the slow MACD at the same time you get one on fast MACD. But we're really doing, what we're trying to do is just generically line up an overbought condition on this particular indicator. It doesn't have to be perfect, doesn't have to be crossing over. It might actually still be trending up with some angle and separation. But ideally, as in this case, you can see MACD has gone well above its waterline, which on the slow setting is what we're looking for, and then starts to flatten out and finally just creeps up and catches up with its trigger line. So this is really the ideal scenario, but often you won't see it, and you'll just have to kind of gauge whether it's sufficiently overbought by virtue of not being, still trending strongly to enable you to consider getting into the trade. The fast-setting MACD below it is a very clear bearish crossover. We've gone over this in great detail in Module 2 of the course. And again, this trigger will happen before the one on the slow MACD. The crossover event on SMI is very similar. The three lines I've got here in this example are the plus 40, minus 40 lines, which denote overbought, oversold territory, and then this dashed line in the middle is the zero line in between. So when SMI crosses its trigger line, which is this dashed line right here, that is analogous to a MACD bearish crossover. And then finally in the bottom you can see here what we want to have happening at the same time is RSI goes very, very overbought, pokes its head way above the 70 line, which is its overbought territory, and then shows some signs of wanting to cross back down. So it's really nice to line these up like this, because when they do, particularly as I've noted over here, when you're looking at resistance on an R level pivot such as R2 or Peter Bain's M3 or M4 levels, it tends to be that much more powerful. So that's more or less what an overbought schematic looks like for the MACD parabolic entry system. And here's what the oversold schematic looks like. No big surprise, it's just the exact opposite of what we looked at for an overbought. you take all of those conditions and just flip them on their head, and that's pretty much what an oversold schematic looks like. So again, what will often be the last signal to trigger us in is parabolic, flipping this time from red dots above price to green dots below. And that is a nice, very simple. What I like about parabolic is that it's just a very simple two-state system. It's more or less you got one condition or the other. There's no shades of gray, no in between. It's either up, down, on, off, black, white, or in this case green, red, and that's all there is to it. So there's no guesswork or wondering about whether it's really a reversal event, whereas when you're working with simple moving average crossovers like a death cross, sometimes you'll get what sort of looks like a crossover happening, but then the two lines converge back on each other and they sort of noodle around for a while. That's generally not the case with parabolic. It's either one or the other, which makes it very clear and simple to read. Again, MACD, the slow setting, you'll have seen it go very deeply oversold, way below the waterline. Ideally, it flattens out and starts hugging its trigger line fairly closely, and then eventually you'll see it start to lift off. But again, this might happen after the other signals have occurred. The fast MACD, of course, it's given us a textbook bullish crossover. And SMI, as in this example, it tends to trigger just a little quicker than the fast MACD, and RSI tends to trigger fastest of all using the 9-period setting that we've got. So you can see these line up from fastest to sort of fast to medium fast to slow, and when they all sort of line up together at the same time, it's a very good system, and finally triggered in with the parabolic green dots here. And again, just to reiterate what we said before, when this pattern happens in conjunction with a successful test of an S pivot, S1 or S2 or possibly S3, it tends to be that much more powerful. So that's pretty much what an oversold schematic looks like. And I didn't get you the prettiest pictures here to the left, deliberately actually to show you, there's a little bit of ambiguity that you have to deal with in real life, but more or less these are all lining up the same way at the same time. So that's what our oversold schematic looks like. The double confluence concept is basically the idea that to properly validate confluence of signals happening on our low-level chart, we need to see a similar confluence happening on at least one higher time frame, ideally the next higher time frame. So we're saying that, okay, parabolic, MACD slow and fast, SMI and RSI, which are optional, let's say those go all overbought all at the same time. To be extra safe in the trade and extra certain that your timing is right and you're trading with the trend, you really need to validate that signal confluence by similar readings on at least one higher time frame. And so that logically from the 3-minute or 5-minute chart, the next higher time frame most people would look at would be a 15-minute chart. So if you're really overbought across the board on your entry signal chart, you should have fairly similar readings on the 15-minute chart. If you've got opposition, it may be kind of a risky setup, and in fact it might be a counter trend setup, in which case you don't want to take it. And what's often the case, what creates a really powerful setup is when you have these overbought or oversold conditions lining up on multiple time frames at once. So let's say you've got a short signal on the 3-minute, you've got your permission indicators on the 15-minute chart, and similarly you're overbought on the 1 hour and or 2 hour and or 4 hour, or maybe even the daily for that matter. When you've got that many time frames lining up the same way, it becomes very, very powerful. And so you really want to try and stack up as many of these doubling readings as you can. And so we'll try and get to an example of that later. But this is just to say that just because you have all of your signals lining up the same way in the 3-minute chart does not mean in and of itself it's okay to trade it as is. You really need to validate that with reference to similar. Okay, so let's get into the actual meat and potatoes of using this system. Here is a chart example, and we're going to go over all of the elements of the signal confluence. So first of all, we're lining up all of these oversold bullish crossover events on our 4 indicator panels, starting with the fastest at the bottom. RSI has punched very far below its 30 line into oversold territory and now is clearly crossing back up the 30 line, which is generically bullish. SMI similarly went below its minus 40 line and is now crossing its trigger at more or less the exact same time as RSI. Then our fast MACD setting went oversold and is crossing its trigger a little sloppily, but it's a crossover nonetheless. And then finally, at the same time all this was going on, our slow setting MACD was still trending down and eventually started to flatten out though. And just the fact that it was fairly deeply oversold is enough of a signal for us, in agreement with these other three, to confirm a potential long entry. So we've lined up all the signals, and what we're looking for then is the first flip after on parabolic from red, which was bearish, to green, which is now bullish. And in this particular case, we have price first testing and then retesting a support pivot, which is this green dashed line. And what sometimes happens if there's any flaw in this system is that you can see the parabolic dot where my cursor is was right here. Price came back down and maybe didn't touch it, but came awfully darn close, and just a few more pips and it might have punctured this level or taken out our stop if that's where we placed it. So you can always add a few pips for safety. I'm not saying this happens all the time, but it is an occupational hazard, I guess, using this system. It happens relatively infrequently, actually, but in this case we had price coming down hard on a pivot, and usually on a low level time frame like this, a 3-minute chart, you really do want to expect a retest. It'll sometimes just come down and then bounce off the other direction. More typically, you'll see some type of retest in this downward direction, which is what happened here. So we could have gone long on the first close of a candle after one of these parabolic flips. We had one here and we had another one here, and in this case the second was actually the safer of the two entry points, because coming after a pivot retest, it was just nothing but upwards from there, as you can see from subsequent price action. So that's where to enter the trade. Get these signals all lining up the same way, then get parabolic flipping in the opposite direction, and once it does, that's the final trigger to say, okay, now's the time to go long. Just the caveat at the bottom here is useful. If you do happen to get stopped out on one of these pivot retests here, again, we're risking relatively little, to often no more than about 20 or 25 pips. So if you do get stopped out, again, just take the second entry signal, because it'll be that much safer. If you've done your homework, you've got a good high-level setup, this is going to be fairly safe for you. So take heart. 20 pips is not a lot to lose, and if it happens, just get back in on the second signal that comes after. The really nice thing about parabolic too, not only does it give us a clear entry in terms of timing, it also tells us exactly where to put our stop. So where do you put your stop? Easy. Hover your cursor over the candle that represents your entry opportunity, and in the case of IT Finance, it'll tell you what the value is for parabolic and any and all of the other chart indicators you've got on the price panel. So if you have moving averages and so forth, it will tell you what the corresponding values are, and that's pretty par for the course for most charting platforms. In this case, this was our entry candle here where my cursor is, after the first close with parabolic flipping red to green. And so we see that the value for parabolic was 230.91. I believe we're looking at pound yen here. And so in this example, we've got the long on the open of the second candle. The entry price is 231.08, of course, plus your dealing spread, which will be a few more pips. So you want to set your stop for this entry candle equal to the parabolic value, which in this case was 230.91. And so you can see from this example, our total risk on the trade, therefore, is entry price less parabolic stop is just 17 pips. So if you're paying 5 or 7 pips as a dealing spread to your broker, that'll give you a total all-in risk of about 25 pips roughly, which for pound yen, again, as anybody will tell you who trades that pair. That's not much at all. That's really nice and tight. Now, again, I alluded to this earlier. If you're trading a slower moving currency like Euro, USD JPY, perhaps USD CAD, you will often see this formula surprisingly often give you a stop that's can be as little as 10 pips or possibly even in the single digits. Just to keep yourself safe from noise. There's no point getting stopped out at 7 or 10 pips. I mean, that's just ridiculous. So you might want to work with a minimum benchmark, say 15 pips is the lowest that you'll take, so that you'll stay safe from noise. Now, I'm not talking about noise on price action itself. I'm just talking about the noise that can happen when you're looking at one data feed on one charting service and working with another data feed on your trading platform, because you quite often can have a deviation of as much as 4 to 6 pips, depending who you're working with. Ideally, you'll have the same data feed on both, but a lot of people use a different charting service from that offered by their market maker broker, in which case 4 to 6 pips could easily take out this very narrow stop risk here. So you might want to just consider having a minimum of, say, 15 pips, and if it's a 7 pip stop risk, just increase it a little bit to give yourself an extra margin if you have this issue of 2 different data feeds. So that, in a nutshell, is where to put your stop. Just read the value for parabolic SAR and put it right there. And that's one of the key uses that was to which this signal was developed by Wells Wilder. He was looking for not only a trending indicator, but an indicator that gives you stop values as well. So that's how to do it. Get in when it flips, put your stop right there, and away you go. Couldn't be much simpler than that. Okay, we're going to go over now a multiple time frame example that shows the entry trigger on a low-level chart in context. And so we're going to look at the pound USD pair for September 24th, 2007 at the London Open. I'm not going to spend a lot of time on more traditional technical analysis in this example. We will look at some simple trend line breaks, but what I really want to do is focus our attention instead on this double confluence concept, which is very important and which demonstrates the power of lining similar confluences of overbought conditions across multiple time frames. So when you have a sell signal on the 3-minute chart happening at the same time as that you have consistent overbought signal confluences on all of these other time frames as well, or at least just 1 or 2 of them, the setup becomes just absolutely deadly. Like, it's literally bankable, at least if you've done your homework. So the key elements of this trade we'll see are: we have a swing point at the London Open, which is a very strategic time of the day, of course. We have some simple trendline analysis that assists us. Pivot point resistance at R2, which is into the Peter Bain sell zone. And again, we have multiple overbought signal confluences on numerous time frames. And we'll see how this all sort of puts together into a really nice trade. All right, so here we are on our 5-minute chart. I'm actually going to work this backwards. Instead of going top down, I'm going to go bottom up. And it's just to sort of, again, put this entry signal chart into context, assuming we've looked at all of our higher level time frames. So what we've got in this particular example, you can see on the price panel, price rallied up into the London Open, giving us a price exhaustion candle on the R2 resistance pivot. Price tried very hard to break through this level and head further up, but it was not successful. It was stopped at the pivot. Was not able to close on the other side, and this is sort of pretty close to a shooting star candle in the Steve Nissen terminology, which is a reversal candle. Steve will tell you that it's a reversal if validated by a lower close, which we didn't quite get. But hey, just seeing price butt its head up against this pivot, that's pretty convincing right there. So the signal confluence reading from bottom up, fastest to slowest, RSI went way above its 70 line and started crossing back down. SMI went way above its plus 40 line and is crossing through its trigger. Fast MACD at the same time went way overbought above the water line and is crossing its trigger. And our friend slow MACD here was still trending up more or less. There was still some angle and separation, but it was still in the context of being very overbought already. So we could put aside our hesitation and not necessarily force ourselves to wait, but we can see subsequently it crossed over anyway. So just reading this on its own merits, as an entry signal, again, once parabolic flipped after this reversal setup from green to red, the entry candle would have been right here, this open, and we would have been short on pound USD at a price of 2.0287. The parabolic stop up here was at a value of 2.0319. That was a risk of 32 pips. Now that's actually wider than you usually see on a dollar denominated major like this, which is what will give me cause sometimes to drill down further into a 1 minute. If the parabolic formula is giving me a stop wider than I expect, 40, 45, 50 pips, I will then drill down further to a 1 minute time frame and see if I can get something that makes sense. In this context, it wouldn't have bothered me to risk 32 pips just because this stop was pretty intelligently placed, actually, above the resistance pivot and pretty much around about the level of this previous high here. And again, we're way in sell zone territory, so I'm not too worried about this particular stop. But that's what our 5-minute chart looks like. Now, let's go to our 15-minute chart and see what it looked like concurrently. What we're doing is trying to find permission, more or less, from the 15-minute chart. We want the 15-minute chart to say to us, yes, I'm overbought too. I have no disagreement with the signals you're getting from the 3-minute. And we can see we got that. This is this price exhaustion candle is concurrent with the one that we saw in the 3-minute chart, actually. And we can see that when that happens, again, RSI was way overbought above its 70 line. SMI had crossed over bearish once, now is doing it a second time and crossing through its plus 40 line. We have negative divergence on the fast setting MACD, actually. I didn't draw that in, but you can see we have two tops that are at roughly the same level, whereas price concurrently was rising to higher levels. So that's a classic divergence signal right there. And again, MACD is crossing through its trigger well above its waterline. And slow MACD still sort of more or less trending up, but has been way overbought for some time and is ripe for reversal. So I'm not seeing anything on this 15-minute chart that says it's a bad idea to consider going short on the 3-minute. Let's look at the 60-minute chart. I've highlighted the same time frame here. We can see from bottom to top, again, RSI very overbought, crossing bearish. Same story SMI, same story fast setting MACD, slow MACD starting to flatten out at this point, and subsequently we were able to draw in a trend line and get a trend line break with a projection down to this level. And I'll give you the exact numbers a little bit later, but you can see how the entry paradigm got us into the trade before we even had the setup on the 60-minute at least, and we could have updated our price projections later after this trend line was broken. But again, nothing on the 60-minute chart that says a short is a bad idea. Now, how about the 2-hour chart? Well, it's remarkable how similar this story is lining up. RSI overbought, SMI way overbought, crossing bearish. Same story on fast MACD. Slow MACD is trending up with angle and separation here. There's no doubt about that. But by this point, we're 2 or 3 levels removed from our entry level or our signal confluence on the 3-minute, and so to get 3 out of 4 like this is not bad at all. Now we do have a nice steep demand trendline break, and we can see if we were looking at this in real time, this would be the candle we were dealing with, and we could see that this is looking like a top here, and it wasn't at all unreasonable to expect a trendline break at this point. And finally, our 4-hour chart. Again, we've got 3 signals for 4 that are overbought, crossing bearish RSI, SMI, fast MACD, slow MACD, a little bit of a holdout, but again, 3 for 4 is not bad. So, in a nutshell, we've got an overbought confluence on multiple time frames, and we're seeing this price exhaustion candle repeating itself on numerous time frames as well. So this is really starting to look like a clear top reversal setup, and there's no reason why we couldn't have jumped on that signal on the 3-minute chart. So to summarize the results from our sample trade here, which admittedly is a textbook trade, but it really doesn't matter because you see these things all the time. It's just it's a daily occurrence. So we went short at 3 a.m. and I actually was content to do that without even knowing what my ultimate profit objective was. I knew that we were looking at a high-level resistance on an R2 pivot, and I know that there's no way this move is going to be worth just 32 pips. I know that there's going to be a number of hourly trend lines broken, and I'll be content to get into the trade and update my profit target later. That's breaking a few rules in the rule book, but with this entry trigger system using pretty often very tight stops, certainly less than 32 pips, that's a little unusual. I'm more than happy to risk 20 pips for just about anything, quite frankly. I'm not too worried about that risk because I know from a system trading perspective, I'm almost always hitting ratios of 3-to-1 and better. So I'm going to jump into it, and I'm just going to update my profit objectives as the trend line breaks unfold in the session ahead. So the stop was placed at 319. It gave us a risk of 32 pips. And once the 60-minute Tom DeMark trendline projection materialized, I used that as my exit strategy. It's generally the lower time frames will be more conservative. In other words, it's easier to hit a 60-minute trendline projection than it is a 4-hour projection. So, realizing that was worth 145 pips, I'd say, yeah, okay, of course, I'm very happy with that. If I get a 145 pip trade every day, I'm extremely happy. Of course, it doesn't always work that way. But our reward to risk ratio, this is where the system is just unbeatable, is this ratio. So we took our profit, we divided it by our risk, and that gives us a ratio of 4.5. Beautiful. Absolutely beautiful. You know, what's great about this is that you can be wrong 50% of the time, no problem, and you will still consistently make money if you're using this kind of system, producing these kinds of numbers. And that's why I recommend this system so highly, because we're using precision timing, tight stops, and we're even doing that when we're looking for big breakout runs. So, cause for celebration, absolutely. So this is an example, admittedly a textbook example, but I think it would be good for you to find a number of your own back-tested examples similarly, and they're just about everywhere. Every pair does this every day, and it's, I think, a really good endorsement of this system. So I hope you found this useful. I kept it fairly short. We could have gone into greater depth using more trading examples and so forth, but given this is a bonus module, I just wanted to sort of more or less recap or reiterate some of the aspects of our entry signal system, that we looked at in Module 8. So I hope that does a good job summarizing it for you.